Hi, everyone, and welcome back to the Nick Halaris Show. Our guest this week is Dara Albright, who's a director at a really cool, innovative company called Worthy Bonds. Dara, welcome to the show.
Oh, thank you so much for having me. Great to be here.
Yeah, I ran across Worthy at some kind of one of the many newsletters that I read about the industry, about real estate and finance, and I thought it was such a cool company and had to reach out to you all to hear more about it. So maybe the best place to start this is just tell me what Worthy is and what you're all up to.
Sure. So Worthy fits into kind of the alternative asset universe. The mission is to enable small investors to have access to alternative, higher yielding or higher growth alternative assets. And Worthy is focused in the fixed income space right now. So what Worthy does is they invest in various real estate projects, a lot of times starter homes, as such. And what happens is they make those investments. These are typically investments that generate a nice, attractive yield. Unfortunately, most retail investors don't have access to those type of investments. Worthy has created a mechanism, if you will, of enabling small retail investors to participate in those type of investments. So how do they do that? So Worthy does that by a exemption from the Jobs Act called Reg A Plus. If you go back into your recent history, there was the Jobs Act passed in 2012. And in it, this was really kind of around with the rise of crowdfunding. And it created new exemptions to make it easier for issuers to raise capital and for investors to access different kinds of investment opportunities. So what Worthy does is they've leveraged this exemption, Reg A Plus, so that they're able to provide an SEC, Securities and Exchange Commission, qualified Worthy bond, which is essentially a bond that yields 7%. And investors could go in as little as $10. So you don't have to be, a millionaire to participate. Just everyday investors are able to participate. And the best part also is that this bond is also liquid. So if someone needs the money, they're able to sell it. Now, that's just part of it. The other part of Worthy is that Worthy has built an entire fintech infrastructure that enables people to collect their roundup. So when you go shopping, you go to your local grocery store, you spend $99.50 at the store, but you pay $100. So that 50 cents is called a roundup. That 50 cents goes into your Worthy account. And every time your roundups hit $10, you automatically are purchasing another Worthy bond that's yielding 7%. So it's a very painless, easy, and fun way for retail investors to save and to build wealth with what my husband calls couch cushion money. It's money that you don't even know that you had. You wake up one day at the end of the year and you have hundreds of dollars saved in an account that's yielding 7%, and it's a great product.
Yeah, I love that roundup feature. Very cool. And if my numbers are right, Worthy has raised quite a bit of money this way, like something like 250 million. Is that number right?
So Worthy has sold over 250 million in bond sales. So yeah, people have been really attracted to the product since it came out over the years, and so yeah, they're just really doing well with their bond sales and with this is investors that are coming in. You have anyone that could come in as little as $10 to as high as I think 50,000. So Worthy has actually set a maximum because they really want it to be a retail product. But I would say, the average investor usually probably is in the, I think it's about 2,000-3,000 range.
Okay. And so that 250 million of bond sales is a lot of people.
It is.
That's very cool. You also mentioned too something. One of the features that I really think is cool about worthy bonds is this liquidity feature, because you can go out, maybe if you're somewhat savvy and you can figure out how to get invested in illiquid securities that yield something close to 7, but they're completely illiquid, meaning you're like stuck in them until maturity. So
Right.
how does Worthy maintain that liquidity?
So, I mean, Worthy is very conservative with, with their investing in, and the yield that they're getting. They're basically they're keeping a very high percentage away to make sure to be able to account for redemptions. Way more conservative than, let's say, banks, in that capacity. So that's basically what they're doing. They're able to they're generating sizable yield that they're essentially sharing with the retail investor. So, for example, like if a retail investor went to a bank and was trying to get, and I'll do a little bit of a comparison to the other kind of fixed income products are out there. And a retail investor goes into a bank and wants to open up a CD. Let's say, for example, number one, they're not going to get 7%. And let's say they get, even let's say they do. First of all, they're locking it up there for a certain period of time. But what a bank does is you know how a bank works. A bank is going out there and a bank is taking the money, your deposits, and they're lending it out to someone else. The bank is getting, in cases, especially with credit cards, they could get up to almost 30%. And then maybe they give, a retail investor a very, very minuscule, piece of that, of interest that they're paying. So with Worthy, we kind of look at it as it's a modern day kind of finance where it's really these, we're not going to see in the future institutions as greedy as banks have been. And I think it's going to be more of a level playing field, and there's more opportunity for yield because the company is just really more, is out there really to take care of the retail investor and help the retail investor. It's more about the mission and the vision than it is about, just how it works in the traditional way. Now that's using a bank as an example. If it's a savings account, you're not going to get anywhere close to 7%. But in a savings account, you're generating, you have the liquidity. So, that's kind of the trade-off. In a CD, you'd have to lock it up for a certain period of time. So there'll be fees, liquidation fees if you want to get out. The other, people look at it as, if you want to compare it to like maybe like a corporate bond or a corporate bond fund. There's liquidity in corporate bonds or corporate bond funds. And, and I'd have to look and see what the yields are today. I still think Worthy is pretty competitive, but the difference also is that in a corporate bond or a corporate bond fund, they're fluctuating with where interest rates are going. So typically when interest rates are going up, the value of your bonds that you're holding are going down. So if you wanted to liquidate it, you would liquidate it for, maybe a loss or maybe under par value. Where the difference with Worthy, it's just a straight redemption. So no fees, whatever you put in, you're getting out. And I think it's a great product. I think it's a great product for especially for retail investors.
Well, zooming out a little bit, as I was preparing for this interview, I looked you up on the internet and read all kinds of interesting articles that you've written and podcast appearances that you've been a part of. You're a person who's kind of been on a mission for like a decade, and it corresponds with sort of the beginnings of, I say the beginnings because I don't think we're done, the beginnings of a revolution in access to capital and access to investment opportunities for ordinary Americans. But tell me about that mission and how you got, like, what drew you to it?
Yeah. So I mean, my background, I come out of a Wall Street background. So I really, in the 90s, I cut my teeth working for a company called Underberg Tobin, which was, they're kind of like the kingpins in the technology IPO world. And they were involved. I mean, they've been around since the 1930s, but they brought Intel public back in 1971, and they were involved in like pretty much every major high profile technology company that came ever since, and went on to change the world. Back at that time, that they're not around anymore. But when I was with them in the 90s, it was an incredible time to see how this was all working. And in the night, well, I'll go back to Intel for a second. So I was not there for Intel. I mean, it's like, that was a very, very long time ago. It was 1971.
Yeah, fair.
When Intel went public, just to give you an example, Intel went public. It went public at like a 50 something million dollar valuation. It raised about $8 million on its IPO. That was Intel's IPO. It went public. And so, Intel, went on to be, a multi-billion dollar company. So those people that had the opportunity to invest in Intel's IPO, they were able to go in at a 50 something million dollar valuation. They held Intel in their retirement portfolios, and they've created, massive, massive wealth. And at the same time, it was that the people's capital, we the people, that had the opportunity to fund the innovation of the day. This company that went on through their innovation to change almost every industry on the planet. So that's how wealth is created. Wealth is created by really the freedom for individuals to invest in the invention and the innovation of their fellow citizens. And that's what made America such an economic superpower. And when I was at Underberg in the 90s, it was still a time, companies, we weren't doing IPOs as $50 million raising $8 million like as was in 1971. But at the time, we were doing small cap IPOs, raising for companies that were maybe raising $30-40 million now, and they were, let's say, $300 million in market capitalization. Those companies still went on to go public, and and they were able to grow in the public market. So they were able to appreciate in the retirement portfolios of everyday Americans. So what happened was, if you kind of fast forward a little bit, it became more and more onerous and expensive for these small companies to do a IPO when they're at that earlier stage in their development. So what these companies would do is that they would wait until they were much, 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 much bigger. So for example, Facebook didn't go public until it was $100 billion in market capitalization. And so by waiting, what had happened was that a lot of these companies, all of their appreciation was going into the coffers of venture capitalists and private equity, not into the retirement portfolios of everyday Americans. And that's a problem. And that is really the problem with our markets today. And the problem is that a lot of these companies, as a small cap, like an Intel, a 50 something million dollar company, couldn't go public right now. I mean, they could, but it would be very, very expensive for them, and it would be very challenging for them to stay public and not have all the, be manipulated by a lot of abusive shorters and that sort of thing. So if you look at sort of the structural issues with the markets, then you have to realize that that these companies are still around. They're still, all of these innovators and inventors are out there creating these companies, and they're raising capital, but they're just not doing it with their fellow citizens. They're doing it obviously by big major financial institutions. So we look at what's happening is that all of that wealth that's being created is now in a very select few. It's in 1% of the population. And people wonder why there's such a wealth disparity in America. Well, it has nothing to do with the taxes. It has everything to do with access to capital. So fintech, what drew me to this whole space was, I just started getting really, really fascinated I want to say probably around 2010, around that time when Facebook was starting to emerge. It was still private. Twitter, you started to see a lot of these late stage private companies in the social media space. It was very exciting at the time. And investors were like clamoring to get shares, even though they were private. And they were doing it on these exchanges. At that time, a lot of them known as Second Market, Shares Post, some of these exchanges. And I thought that was very interesting because it looked to me like it was almost like we were seeing another revolution in the markets, just like how NASDAQ came in and transformed the stock market. We were seeing kind of something similar happening because this is where all the exciting companies were. So I just started, following that. And then from there, I started following a lot of the regulations and the legislation at the time. The House Financial Services Committee, this is fast forward maybe about a year later. The House Financial Services Committee came out with they passed a bundle of bills that we now know as the Jobs Act. And in that one of them was this Reg A Plus I alluded to before. Another was the crowdfunding. And it was all of these new bills to make it easier for issuers or innovators to access capital from a broader audience, smaller investors, and for smaller investors to participate. And I just thought this was fascinating. I started writing about it. I started just holding events about this and just getting the discussion going. And when the House Financial Services came out with that bill, and I think it was around October 2011, I had wrote an article called Bipartisanship Prevails for Job Creation. And in it, I talked about, wow, this concept of crowdfunding is really, really fascinating. And so I reached out to Congressman McHenry, who was the congressman who introduced the crowdfunding bill, and invited him to speak at the next event that I was putting together, which became the very first crowdfunding conference in America. And then that's how I met Sally Outlaw, who is the CEO of Worthy. And Sally, at that time, she's one of the thought leaders in the crowdfunding movement. She had written the definitive book called Cash from the Crowd. And her mission was really focused on helping these small issuers or these innovators, inventors, if you will, tap into capital through rewards-based crowdfunding. And so basically, if your audience knows, for rewards-based crowdfunding, that's like a Kickstarter type of model where it's basically a pre-sale of something. Someone has an idea, and they'll go and they'll make a video about it, and they'll see if people are interested in funding this idea to make it a reality. And then people will be rewarded for investing with, they could get, different types of perks. Maybe it's like a discount to the product or, first access to the product. The problem with that, though, is that they're not getting any equity. So they're not getting the ability to really grow their retirement portfolio. And the crowdfunding movement was really all about, Congressman McHenry basically wrote the bill it's a great story, actually. It all always comes down to beer. But there were two guys that were marketing guys, and I think it was Pat's Beer was looking to see if they could find a company to buy them. And so these guys just went on the internet and created a website, buyabeercompany.com or something like that. And they raised like hundreds of millions of dollars, sitting around drinking beer.
Yeah.
Hey, let's buy this beer company. How cool will that be? And they had to give all that money back. And it was Congressman McHenry that said, why is this legal? Why, I mean, is this illegal? Why can't we make this legal? So that was what the whole, crowdfunding movement was all about. And that's, originally how I met Sally, through sort of, the early days of this whole crowdfunding movement. And, both of our missions were completely aligned in, it's all about democratizing access to capital for small investors and for, small businesses, innovators, inventors. And so, we've been sort of on, that mission ever since. And it just keeps evolving, and it keeps getting more and more interesting. And I think, that's even what the whole blockchain movement is even about today. On the cryptocurrency side, it's all about access to capital, creating new ideas, and bringing those ideas, democratizing access to capital. So yeah, it's been a fascinating ride.
Very cool. Yeah, a couple follow-ups. One, it sounds like, just from listening to your story, thanks for sharing that the thing that bothered you was the fact that ordinary Americans were being sort of left out of the opportunity to participate in the very best investments.
Exactly.
Yeah. I sort of been thinking about that, and I just wanted to share one thing that happened to me. I came of age in business right as the tech wreck was reaching its crescendo, or the tech bubble was reaching its crescendo. And I remember vividly being in this, it was a First Union Securities office, and IPOs were coming, and the share allocation for these IPOs, it was completely unfair. Only the best clients got it, right? Like the ordinary client who had a couple 100,000 in their 401k, no chance. If you had 10, 20 million, you're going to get I remember, right. I think it was mp3.com or something was coming out, and only the top clients got the mp3.com thing. And then of course it tripled on the first day, and these people made a whole bunch of money. Meanwhile, ordinary Americans were not making anything. So I vividly feel that, that unfairness that's in the system. And have seen sort of the evolution that you've described, where man, now nobody except for the top 50 venture capital firms is participating in that exponential growth phase. These companies are coming to market when they're just done. They're done growing in some cases.
Exactly.
Yeah.
Exactly. And, to your point too. So, I mean, I worked on a syndicate desk, so it was all about the allocations when we were taking deals. So I knew how that worked. And I mean, some retail investors did have access, but you had to know someone at the firm in order to do it. So you really had to know somebody to get.
You had to be a whale. You had to have some kind of thing. Yeah.
Right.
And the other thing I was thinking about as you were describing it too, this is recent history, but it's probably history that people don't remember, is that one of the reasons why we got in the situation we're in today is that in the aftermath of the tech wreck, there were these massive financial frauds, Enron, WorldCom, and they passed this legislation, which I believe is called Sarbanes-Oxley, which made it really expensive basically to be a public company, because they were like, those cases, they weren't really related to the tech wreck in the sense that they were just people just lying on their books.
Exactly.
And so, Sarbanes, the Congress at the time was like, how do we prevent people from getting away with lying on just straight up lying? And so they created this regulatory framework, but the downstream consequence of that regulatory framework was that none of these companies could go public until they were much bigger to pay for all these regulatory costs.
That's 100%. And if you look at it I remember I did an event. It was really around the week that Alibaba went public. So it's around 2014. And at the time, there was a banker, investment banker at the event that was involved in the Intel IPO, back in 1971, the Alibaba IPO back in 2014. And he still has his Intel prospectus, which is, basically what you send out to retail investors when the company is going public to talk all about the stock. And it talks about, the risk factors and, and the history and, and all the information regarding that offering is in that prospectus. So he said, the Alibaba prospectus was was over 300 pages, and the risk section was like 39 pages just in the risk disclosure section.
Yep.
So he went back and looked at his Intel prospectus from 1971. The whole thing was 38 pages.
Yeah.
So when you talk, look at all of this, there's so much red tape and there's so much, that waste. And you're right. I think the government has, and look, what Enron did, what what they did, but that was flat out fraud. That was just fraud. I mean, you want to punish fraud. I think that's great. But even in the 1930s, when the SEC originally emerged, the SEC came to be in 1933 because it was, at the height of the Great Depression, and it was in response to the stock market crash of 1929. And they said, oh, we have to stop all this fraud. They caused the depression and they caused the market to crash and all this, except one problem. That's not what caused the market to crash. And that it had nothing to do with fraud. It had to do with over leverage. So, the government comes in and says, we're going to fix things by making it more difficult for companies to access capital, individuals to participate. And that's not even fixing the problem. It never even eliminated the fraud. Look at all the fraud that happened since 1933, or even since Enron and WorldCom. It didn't even eliminate the fraud. Yeah. So there has to be a better way.
I think so too. And I think it's human nature to look at these things and try to blame them on something. And fraud is like an easy one. But if you study financial history, right, there's like a fraud cycle. Essentially, anytime there's like exuberance or irrational exuberance in the market, a bunch of people are going to commit fraud. And when the exuberance fades and the market crashes, all the fraud gets revealed because there's nothing to hide behind anymore. And there's probably no way to regulate away from that. Like human beings are prone to lie, and especially when they have the incentive to lie, they'll do it. And you can't really regulate your way out of it. It's impossible in my view.
I think you're right. And every single industry, it's not just fine. It's everywhere. So it's very, very difficult, and you may not be able to prevent it through regulations, but I think what you probably can do is maybe provide harsher punishments for fraud. So maybe people would be, they wouldn't do it as much because they realize that, look, if you could be, like in the old days, they would hang people for probably far less. So, if you have these I'm not suggesting that, but, if you have really harsh punishments, then I think that's probably the best way to prevent people from they would think twice.
Yeah, I think so. And I think that's why there was, in the aftermath of the last crash, before the crypto crash, the crash that almost brought the world to a halt, there was so much anger, especially among like the astute students of financial history, the thought leaders on Wall Street, because nobody got prosecuted when the great financial crisis happened.
Right.
And people are getting prosecuted this time around, like Bankman-Fried and all this stuff. But when the banks almost failed, like nobody went to jail, and everyone got really angry about that because it showed kind of like, wait, is this an unfair world? Is there no consequence for these activities? But maybe they've learned their lesson. Maybe the authorities have learned their
Well,
lesson from them. I'm
I
not sure.
don't know about that because it seemed, I mean, even look, we look at the SEC right now, Securities Exchange Commission, their biggest division is enforcement. So their main job, and where they basically allocate most of their money to is enforcement. Now, they could enforce true frauds. Now, they could have found Bankman-Fried long before, that people lost money, but they didn't. Gary Gensler was meeting with Sam Bankman-Fried. Why, I mean, none of that makes sense. But the problem is that the SEC also uses their enforcement division to target people who aren't even committing fraud, but just people who are, what they call issuing unregistered securities. So they go after a lot of these companies for issuing unregistered securities, and they go after them hard. And the problem is that, in many cases, especially in the crypto space, these companies, who's to say that these are unregistered securities? Because there's no law that says what's, a security and what isn't. So they're going after our fellow citizens for basically for something that we don't even know if it's even illegal or not. And that's a problem too. I mean, we need to really, I think there needs to be, the SEC really needs to be fixed, because there's a problem. Because the more that they do that, then the industries and the innovators are not going to go out and have these conversations with them. They're not going to work with them. They're going to do things outside the US, or they're going to do things, all in, on digital. They could just do it in all different places. And that's a problem too, because if back to what we said before, it all really comes down to what made America the greatest superpower in the history of the world was the freedom for its citizens to invest in the invention and ingenuity of its fellow citizens. And if we don't have that, or they're trying to obstruct that from happening, it's going to happen somewhere, but it's just not going to be here.
Yeah, and I completely agree. I think that's a really insightful point. And in just thinking out loud, it seems like in the last decade, let's say 10 or 15 years, we've made some strides in terms of opening up access to investment opportunities. Obviously, like the Jobs Act, like you referenced, and crowdfunding, and all these like exemptions from the SEC's onerous registration requirements. But do you think, as someone kind of working in the space, do you think we've done enough in terms of changing the landscape for access to capital? Like I've had some people on the podcast, for example, like women and women of color, and it's not necessarily like America's not necessarily fair in terms of that side of the equation. But what's your take? Like, how does that landscape look today?
Well, so that's actually a great point. I think that that demographic they're hurt most by the SEC. I mean, that's just a fact. It's worse for minorities in all different demographics. It's harder for them to access capital because of these rules. So the more that the SEC comes out and make, the more restrictions we have, and the more they make it, the more difficult they make it for small issuers or small investors to participate in capital markets, the more it hurts those markets.
Let me just summarize for the audience how the SEC works. Like essentially, in the aftermath of the Great Depression, the Congress came up with this idea to create the Securities and Exchange Commission. And the regulatory framework had sort of three components. One is this registration stuff that we've been talking about. And the idea was you can't sell a security unless you register it with the SEC. And the
Right.
SEC was going to act as this sort of referee to ferret out the fraudsters. And then secondly, they created accreditation, which is, hey, only people who we deem as financially sophisticated are going to be able to invest in unregistered securities if they exist. And then they have the enforcement, which you mentioned. So let's go through those one by one. Like,
Yeah.
what do you think of accreditation as an idea?
Yeah. So, I mean, you'll get me started on this one. So, so first, when the SEC originally started in the 1930s, it was all about, you needed to file a registration statement if you wanted to sell, securities to the public. There wasn't a carve out for accredited investors until much, much later. So that really didn't happen until till like the early 1980s. The interesting thing about that is when they came out with the accredited investor rule, and I've done so many studies on this. I mean, you could see there is a significant. You compare wealth disparity in this nation. There is definitely, you could definitely see the link between when, the accredited investor rule came out, and especially because also at that time we're starting to see more and more companies staying private longer. So all of these opportunities are in the alternative asset landscape when the companies are still private. So as far as the accredited investor rule is concerned, I mean, I'm on the record saying that I think it is completely unconstitutional. I think that we've gone in this country we've been through that road before, like, in the 1960s, and we don't judge people. We're not to judge people by the color of their skin, their gender, their religion. What we're not supposed to do. So why are we judging them by the size of their wallet, or the size of their net worth? It's the same thing. I mean, to me, it's completely unconstitutional. So I think that, I think people are waking up to that a little bit more and more and starting to see, yeah, it doesn't make sense. And even so, basically, just going back to the accredited investor rule, it says that you have to have a certain net worth, or make a certain amount each year in order to invest in these alternative assets to get the greater yield or the greater growth. Now, what had happened was people started waking up and seeing that, yeah, this doesn't seem fair. This isn't fair. So Congress came out with, they started to come out with new rules, introduce new rules to change that. And there was a bill that a lot of them are saying, we have to make this more knowledge based. People shouldn't be, it shouldn't be based on someone's, net worth or the size of their wallet. We need to, if people are smart enough, and understand the risks involved, and they can make their own decisions. We let them go to Vegas, and put all their money, on the craps table, but we can't let them take money and create wealth by investing in their, fellow innovator. So we sort of changed that around. And in recent years, there's now a way that you could become an accredited investor if you don't meet the financial qualifications, but if you meet the knowledge. So you could take a test for that. That brings in, there were a lot of, for stockbrokers. There were stockbrokers that, understand these markets very, very well, but didn't meet the financial requirements. Now they are able to, to be included in the accredited investor category. So I think we are going in that direction, although Gary Gensler, this SEC that we have now, I think that they were looking for ways to kind of go backwards and
Yeah.
kind of make more restrictions on that. They were in talks to, now we have all this inflation, so now that with inflation we need to go and raise those financial requirements even more. But fortunately, that so far has not passed. So I hopefully we'll stay in this direction of more knowledge based and so give more, because I think it's all about access, because you're only hurting, even looking at from the investor standpoint. If an investor doesn't have the opportunity to invest in and diversify their portfolio with accredited, with alternative assets, they're not getting the same, they're not getting the same opportunities to as the institutions are getting, or the accredited investors are getting. They're not getting the same opportunity to access better risk adjusted returns. And that's not fair. Just because someone doesn't have as much money as someone else, that means that they can't have those same portfolio returns. I mean, it doesn't even make sense.
Yeah, it's completely unfair, and it's paternalistic. Are
Yeah.
you in favor of just getting rid of accreditation altogether, or do you want to have it be knowledge based?
I think that's a great question. I mean, I think if it was all knowledge based, I wouldn't have a problem with that, because I think people do. There are, like we talked about it before, there are fraudsters out there, and I think if we really do want to, eliminate people or prevent people from getting taken advantage of, the more the better off you'll be. So I think if there's more opportunities for people to just kind of be aware, learn what the risks are, learn what to look for. I mean, people need to understand, how to, how do you identify a fraudster? I mean, it's very hard, but I think if you are able to, that would be like one thing that I would even put in as, in an educational program for financial literacy or investing literacy is, how to identify a scam. And there are ways to do it. I mean, it was a great example actually years ago when the crowdfunding movement was getting started. And there was a company that went out, and I think they raised a bunch of money on Kickstarter. And so it wasn't equity, but it was, they were still taking people's money, and they raised a bunch of money. And then, what happened was, like, within literally like 2 days, it was like 48 hours or something, they realized it was a scam, and the crowd identified it as a scam, because all they did was they saw that they went and they looked at the LinkedIn portfolios of the people who were doing of the campaign, and they said, okay, they're using stock photos. This name doesn't make sense. Like, there were just ways that they were able to come and say that things didn't look right or smell right. And literally it was taken down within 48 hours. And look, if you think about it, compare that to how long it took the SEC to go and go after, Sam Bankman-Fried. So I think there's a lot of power in the crowd too, when it comes to, even identifying fraud.
Yeah, I think so too. And I think one of the weird things about this whole discussion, in my opinion, is like, having been on sort of both sides of it as someone who's, raised money, for example, from investors, and who talks to people who do that regularly, but also talking to high net worth friends and investors, is that basically, like, no one's happy with the status quo when you talk to people, right? Like,
Right.
the people who are trying to raise money, like my private equity friends who do real estate deals, they would much rather crowdfund than go and deal with these like institutional investors who have unrealistic expectations about the timelines of all their investments. They'd much rather deal with that. But it's, so difficult because of the accredited investors rule and the registration rules that, there's opportunities for it, but it's not wide open.
Right.
And then the same is true on the other side. The investors, they would love to have access to these elite private equity real estate deals, but for all the same reasons they can't get it. But it seems like the only people benefiting from the status quo is like mega institutions like, I hate to pick on Blackstone and BlackRock and blah, blah,
Right.
blah, but that's basically who's benefiting from this because they're channeling the excess savings from investors to wherever they want it to go.
Right.
And then the high net worth people on the other side are, doing their thing, which is maybe inevitable. They always do, which is hoarding opportunities for themselves. And
Exactly.
yeah,
And and if you think about it too, I mean, the accredited investor, doing away with the accredited investor rule doesn't only help the investor and the investor, have access or have greater risk adjusted returns and they're, getting greater portfolio diversification and all that. It also helps the issuer as well. So if a company is out there raising capital, do you want, one BlackRock as your investor? Sure. It's a lot easier to go to one meeting to BlackRock and say, all right, yeah, we'll fund the whole thing. We'll write you, the check for $30 million. Now, let's say you have, a handful of these big sizable investors in your public company. Well, one of those decides one day that they just feel like they want to readjust their portfolio and they want to just, liquidate their position in your company, your stock tanks. But if you had, a diversified investor base, if you had a million different small investors, if little Susie goes and liquidates her shares because she needs to go, pay for a root canal, it's not going to affect you.
yeah,
So, I mean, people need to understand that there's diversification works both ways.
it does. Yeah, and this whole conversation really just it drives home something that I've been writing about a lot in my newsletter and talking a little bit with the podcast guests, which is like there's a financial literacy problem in this country that it's basically top to bottom.
Yeah.
Because at the highest level of government, for example, you have people who are financially, not that savvy, but they're
Right.
making decisions like SEC enforcement decisions or the allocation of enforcement resources in one direction or another, or passing legislation that may have good intentions but has all kinds of negative impacts. And then you have, everywhere down the line, right? People have varying degrees of understanding of finance. And yet we're categorizing everybody on this paternalistic view of like, hey, do you have $1 million of net worth or made 250K or whatever those numbers are? And it's messing up the whole flow.
Exactly.
Yeah.
I think you're right. I think it does all come down to education. I think, the beauty is that now we have so much information at our fingertips. So there's really no excuse not to, everyone could be financially literate today. I mean, you could go online and you could take classes. You could even, just watch, YouTube videos. I mean, you have to find obviously, legitimate people
Yeah.
and people that you could trust. But there are, we have information at our fingertips. So there's really, the opportunity right now to have a financially literate society. Like, look, we had hundreds of years ago, I mean, there was a large part of the population that couldn't read. Now, pretty much everybody, knows how to read. I think it's going to be the same thing in finance. It was different maybe, 20 years ago or 30 years ago when you didn't have all this information at your fingertips and you had to get either into the industry or, sit in a library or go to college and, take classes on it or whatever. But now anyone could be financially literate if they want to be.
That's right. It's an optimistic point to note. It's like you can have access basically to the smartest investors and finance minds on planet Earth for free on
Yeah.
Twitter, for example,
Right.
or on YouTube or whatever. I follow so many people who just freely offer all kinds of resources.
Yeah.
And I'm advocating all the time for people to take control of this one aspect of your life. Cause like, if there's some kind of like secret plot to control you, like it's in your finances. That's what's
Right.
actually happening. Yeah.
100%.
Yeah.
Right. Right. So true. It was interesting. Like, so I saw on LinkedIn a couple of months ago that someone had posted, they had actually compiled a a folder of just all documents from like all the smartest, financial minds. It was like Warren Buffett and all of his
Yeah.
statements, and so this is all out there. I mean, you could just go, read. You could read all of their, their information. It's all public. It's out there. You could find it.
Yeah. And you've written a bunch of articles, which I'm gonna link to as well. Like you've been a bright light in education as well in this space, which I really appreciate. And I'll make sure everyone gets access to that. One more question. We're coming to the end, but in my research, I discovered that you're also into. We have a shared interest in Stoicism, and I
Oh,
know you've been writing about it and thinking
yeah.
about it. But I guess maybe the question is like, what drew you to it? How did you get into it?
Oh, wow. I'm so glad to hear that you're into that. So my story was around this was actually around 2014. So it's about 10 years ago now. It was sort of at the I had just, well, it involves a whole lawsuit and whatever, but I was involved I had gotten involved in a lawsuit with my company, and it was just a very, very difficult time. And at the time, I'm not going to obviously go into any detail about that, but at the time that this was all unfolding and I was on the verge of losing my company, I had come across an article that talked about Stoicism. And it was a story about Thomas Edison. And it was a story about Thomas Edison, who at 67 years old saw his whole life's work basically go up in flames in a factory explosion. And so he lost everything. And he turned and he looked at his child and his wife, and he said, look at that fire. You're never going to see anything like it again. And the next day he woke up and started again all over from the beginning at 67 years old. And it just really resonated with me because I was on, the verge of, at that time, I didn't know what was going to happen. Was I possibly losing everything that I had worked for all of these, recent years. And to me, it was especially difficult because I don't really look at it as what I was losing from a financial perspective. I was actually looking at it as my kids at the time were very young. My daughter was in kindergarten. My son was in like second grade. And to me, all that time I spent working to build my business that I was on the verge of losing, to me, it was hours out of my time with my kids. So for me, it was just very, very personal. And when I read that article, it just really, really resonated. And then they said in the article that when Thomas Edison said that, it was sort of like, that is what Stoicism is. It's the ability to look at things like that. So I started looking more into, Stoicism and what it means. And so I went out the next day after I saw that article, and I changed I got a new Twitter account because my Twitter account was being taken too. This was all part of the whole thing, and changed my Twitter to the Stoics, and I just never looked back. And to me, Stoicism is just about it's about rising above and in the face of adversity, and and not to me, it became very, very important for people to understand, for me personally, but I started writing a lot about that. I actually do a personal blog, Stoic Rantings, where I kind of talk a little bit about, just ways of looking at the world, through like the eyes of a Stoic. And to me, it makes me feel like, to me, it's very special. How did you get involved in the whole?
Yeah, thanks for sharing that story. Like Stoicism is, I always tell people it's, in my view, it is the best sort of psychological operating system for crisis that's ever been invented by human beings. Like whatever the Stoics were doing, they figured out how, a system for like, hey, if your world is in trouble, you should listen to what we're talking about.
Right.
And I think it works so well because it prioritizes action, that like rather than like thinking and say, because what happens a lot in crisis is you ruminate and you think about it and you feel bad about yourself. But Stoicism, all of its sort of aphorisms are geared to get you moving, get
Yeah.
you doing something. And when you're doing something, you don't get hopeless. You get excited because you're like, okay, I'm going to work myself out of this or whatever. It just gives you this like reframing tool. It's phenomenal. But I came to it in a similar way. Like I had a lawsuit about a decade ago. I had been reading the Stoics for years just because my father's from Greece, so I'm interested in all this ancient stuff. But I really incorporated it into my life in these crisis moments, just like you. I think that we share that same story, and it really works. I highly recommend it. And maybe we'll do another episode just about how to implement Stoicism in a moment of crisis. That could be
Oh,
interesting.
I would love that. I would love
Yeah.
that. Because yeah, I mean, I think people, you could go through a crisis in your life and you could look at it and say, "Oh, woe is me," and and this was the worst thing that ever could happen, and you could just, fall into, basically just everything will just continue to get worse, worse, and worse, and worse, and you'll just sit there and never get out of it. Or you could look at it and say, this happened. Yeah, it sucks, but you know what? I'm going to rebuild and I'm going to rebuild and I'm going to come back better and stronger. And to me, anytime that I've ever had, things don't always go your way, and when they don't, and when they don't go your way, and instead of just saying, all right, well, that's it, didn't go my way, I'm going to give up. Instead, I've always turned it around because it's because of, I guess, because the whole stoicism appeals to me. I mean, that's just, to me, it's my nature. I just feel like, I'm not going to give up. I'm never going to give up. And I'm going to just, I'll find something else. It's just, and then, and I look back on it and I look back at, like I'll look back even now, I'll look back on the whole lawsuit battle and all of that. And I'll look at it and say, you know what? That was actually one of the greatest experiences of my entire life. I really do believe that. When you're in it, it felt at times, devastating. Felt like I was going to lose everything. But now that it's, completely so far behind me, and I look at it and I think that was one of the best experiences of my life. I mean, I learned so much from it. I look back and it was a really great experience.
Yeah. Well, I'm glad to hear you say that, and I agree. I feel like these crisis moments are necessary because once you survive them, they give you a sense of agency that you didn't have before. Like you just know you're sort of
Yeah.
battle tested and you can handle it, um,
And
which is what.
you do come back stronger. You do
Yep.
come back stronger and better.
Yep.
And when you do rebuild, the next thing you rebuild is even better and stronger. And you're smarter and you're wiser. And, I mean, with my situation, with the legal thing too, I mean, it was years and years and years. I ended up going and defending myself pro se in the Southern District of New York and prevailed.
Wow, that's
So,
incredible. Okay, so we have to do an episode on that
yeah,
eventually because that is highly unusual for someone to go without a lawyer and just fight. That's
yeah,
amazing. Wow. Well, we'll leave that as a cliffhanger for our next episode.
right. I love
But,
it.
Dara, thank you so much for coming on the show and for the work that you're doing to, make America more fair when it comes to finance. I think it's amazing, and I'll make sure everyone knows where to find you online. And we'll look forward to doing this again.
Thank you, and thank you for all you're doing as well, and and getting this, these messages out there, and it's so important. I love even just like the whole podcast arena. And it's the same thing as finance. Everyday people investing in everyday people and in their inventions and innovations. This is everyday people, telling their stories, talking to everyday people and giving them an opportunity to learn something or make their lives better.
Yeah, exactly. That's the mission. And we're living in an incredible time. I mean, you literally can go on podcasts and listen to the smartest people on planet Earth on any subject.
Yeah.
Pick your subject and you can do it for free, which is
Right.
like, talk about democratization. That's an incredible opportunity.
Yeah.
So I'm just trying to do some small part in that bigger effort.
I love it. I love it. Yeah, we'll definitely do another one with stoicism. I love it.
I can't wait. Yeah. Thank you so much. And I'll talk to you again soon.
All right. Thanks so much.